How painful will those corporate earnings announcements be throughout the year?
Well, there's something to adjust to later. It looks so much in the analyst earnings estimates like the fourth quarter was the recession, and here we are sitting in the recovery. And it actually looks a little bit like that in financial markets. And it would be wonderful if that were really the truth, if we weren't just on the leading edge of the hit that we're going to have in profits. And of course, how markets traded last year are not anticipating this to be, some kind of profit nirvana. We don't have 20% declines, without something. But if you really take a look at the estimates, they fall at a 15% annualized rate in the quarter past. This is like setting a hurdle that a toddler could leap over. Most companies, by far, are going to beat those estimates. But then they're putting all that promise of the future that the year will be a growth year for EPS in the out quarters. But as soon as the second calendar quarter, the April through June quarter, there's a substantial gain. Now, there's some complexities. When you beat your earnings estimates, it's easier to hit those later numbers because of the level they come in. But the idea that this is all behind us in the economy, I don't think that's true at all.
Then how do you participate? I'm going to assume that Citi Global Wealth Management is not enjoying being 185% in cash like the triple leveraged all cash fund. How do you participate? How do you participate if you're not all in cash?
Well, look, we've got to live with the ups and downs of equities markets, and we've had 3 rallies in excess of 10% since the Fed started tightening. The real rally, the turning point for the economy, the beginning of a new recovery is likely to begin this year. 2024 could be a stronger year for the economy. Do we think that we should already be discounting this recovery? No. So we are playing it safer. Again, our largest overweights are in firms that are the most consistent dividend growers, in pharmaceutical shares that have low cyclicality. I think this very near-term period, especially before we see the January employment report and we probably see the Fed deliver a hawkish 25, is probably going to be a period where we're going to have to settle back a bit. And again, that does not tell us to time the market and be all out of equities. But we're okay with a short covering rally and low quality shares and just missing that for the near term.